What are similar biases to recency bias? Have you ever made a trading decision based on the most recent market movement, only to regret it later? This is a common scenario influenced by recency bias. But it's not the only bias that can affect your trading. Let's take a closer look at some similar biases that can impact your decision-making in options trading and risk management. First up is unknown bias. This happens when traders think their skills led to a win but blame bad luck for losses. This can create overconfidence and lead to taking on too much risk. Like recency bias, it skews your view of performance by focusing on recent successes or failures rather than looking at the bigger picture. Next, we have confirmation bias. Traders with this bias tend to seek out information that supports their existing beliefs. They often ignore data that contradicts their views. This can reinforce poor decisions based on recent events, causing traders to hold onto losing trades or overlook warning signs. Then there is hindsight bias. This occurs when people believe they could have predicted past events after they happen. In trading, this can lead to overestimating your ability to forecast market moves based on recent outcomes. It's similar to recency bias in that it places too much weight on the latest results. Another related bias is availability bias. This bias makes traders relying heavily on information that is most readily available or fresh in their memory. This often leads to an overemphasis on recent news or market events, ignoring longer-term trends or historical context. Anchoring bias is also important to consider. This occurs when a trader fixates on a specific reference point, like a recent price or event. Decisions based on this anchor can limit your ability to adapt and skew your risk management strategies. Lastly, we have overconfidence bias. Often linked with recency and unknown biases, this leads traders to overestimate the accuracy of their recent judgments. This can result in larger positions or ignoring risk controls. In practical terms, these biases can lead traders to overreact to recent market moves or news. They may ignore broader historical volatility or fundamentals. This can cause deviations from trading plans, like holding positions too long or taking excessive risks based on recent wins or losses. Recognizing these biases is essential for maintaining discipline. By focusing on consistent risk management strategies and using historical data alongside recent information, traders can avoid making decisions driven solely by the latest market events or personal experiences.